equity as a whole. Filelo, thank you so much for being here this morning. Great to have you, and the stage is yours.
Thank you very much. Good morning, everyone. And thank you very much for taking out your mornings to come and listen to our story today. I think, as Eugene has introduced me, my name is Filelo Machekane. I've been with Visio for the past 15 years. And I'm basically right now heading up the SA equities for the funds that we manage. And my topic for today is basically navigating the current market volatility. The previous speaker spoke about how the gold price today could be substantially higher, just given what's happening globally. Investors are losing confidence in the markets, in central banks, etc. I think we'll cover a little bit of that later. As an intro, who is Visio? We've got a team of 13 investment professionals covering domestic equities, covering global equities, and also fixed income. Our experience in the market, we've got over 30 years in fixed income, over 27 years in SA domestic equities, and in hedge funds. The firm was started as a hedge fund business back in the day. And we also have offshore experience of about 25 years. When I initially joined, it was to co-manage the Pan-Africa funds. This was 15 years ago. So we've got that alongside the 13 years managing Sharia funds. From exposure point of view, we are quite a well-diversified team, as you can see on the chart on your right. We've got various levels of exposures from a qualifications point of view. It brings with it some positive dynamic in that views are challenged all the time. We've got very different ways of thinking about different ideas. And so as a result, it improves our investment process extensively. So we've identified two key drivers of volatility currently. We've got in the one bucket, global drivers, then in the second bucket, domestic drivers. I think as we've spoken, the domestic environment remains quite challenging. The consumer remains under pressure, businesses remain under pressure. Having said that, what we've seen is that interest rates remain quite elevated. Our inflation rate right now is about 3%. Right? The gap between our prime and inflation rate, our prime lending rate and inflation rate right now is closer to about 7.5%. That's quite big. I mean, we haven't been at this level over the past 5 years. And I think the consensus is that there is significant room for that gap to narrow significantly through rate cuts that come through. We've got reforms that are taking place. And again, consensus is that they're not taking place at a fast enough pace to actually drive more investment, drive more employment into the economy. However, there's a positive backdrop to the SA macro. The recovery and continuing increase in precious metals is quite significant. We've seen it, first of all, taking place in the gold space. And more recently, we've seen PGM prices actually rally quite substantially. What we've seen historically is that whenever we had a big rally in PGM prices, you started seeing it making an impact in the economy, call it 12 to 18 months after. So in our view, call it H1 next year into H2 next year, you will start seeing an improvement in government revenues as a result of better profitability from these companies. In addition to that, better employment by this industry. And lastly, better returns. We don't think the stocks are pricing in the higher metal prices, and we think the recovery will continue. Look at globally, on the other hand, the US inflation rate is the same level as ours at 3%, right? But they're about to cut interest rates despite the rate being above their 2% target. So this is not a great environment for the global macro. In addition to that, you've got the continuing tariff issues. I don't think it's settled. I think it was a day or two yesterday, actually, the US and China met, still trying to resolve their trade negotiations. It has not settled at all. And we still to see what the impact is going to be on the rest of the world from these higher tariffs. The data that came out of China a day ago as well has not been supportive of global growth. Consumer remains weak. Investment numbers went backwards. In addition to that, house prices continue to fall. So it's not a great environment for the Chinese economy either. And as a result, support for broader commodities is likely going to be muted in the short term. Additionally, the previous speaker spoke about the global geopolitics. We've got the issues in the Middle East and in Eastern Europe as well. Those are both supportive of commodity prices, and they've resulted in elevated inflation in some cases, and they'll continue to be disruptive. So the picture that I'd like to take you from here is that the global macro is not great. So it's not good for investing. And if you look at the domestic space, it's not great, but there's some positives that we can take away if we look forward. So these are the two charts I'd like to highlight. I mean, if you look at domestic equities, right, we are sitting on a 10-year basis below our average 14 times PE multiple. So we are cheap, right? Our environment is challenged, but we are cheap. So which informs us that there is limited downside risk that we are facing in the SA market, and there is an opportunity to actually buy into attractively priced companies. On the other hand, if you look at the rest of the world represented by the US, sitting way above the 10-year averages, pretty much recovered through COVID past the levels that the market was at pre-COVID. So on the other hand, we remain below pre-COVID valuation levels. So we think there's a great opportunity, and we don't know when the catalyst will come, but you can pick great run companies which will give you good returns in the years to come. Because the environment remains quite uncertain, we don't think it's a case of rising tide lifting all boats. So we remain quite selective in the names that we invest in. So the companies that we will buy into our portfolios have to have strong corporate governance, experienced management team. It's been tough. For over a decade, it's been tough. So the companies that have managed to negotiate through all these issues, call it COVID, call it the riots that took place, and the mismanagement of the SA economy, they are very well experienced. And we think they'll continue doing well if the environment remains as is. In addition to that, the companies must have strong free cash flows and strong balance sheets to be able to stand on their own. I'll call out some of the themes that we've identified as representing the companies with our funds. Offshore and global companies, we like process, and we just think it's a cheap entry into Tencent, which is a Chinese-based company, where we expect earnings to continue growing in excess of 20%, and we think process offers good value from that point of view. We've got gold exposure. We remain constructive on gold. We're sitting at an overweight position there, and I've just highlighted Anglo Gold Ashanti there, and we think it is the best of breed within the space available to SA investors. We've got special opportunities, which is mainly made up of domestic companies. So these are companies where there could be a value unlock opportunity, or where these companies are actually in a turnaround phase. Turnarounds here, Tiger Brands, I think it's an ongoing phenomenon. They've been losing market share for a number of years, but because of the new management team looking at things differently, they're trying to claw back. They're actually clawing it back, and we've seen it in the share price. We got involved in Tiger Brands. I think it was at about 180 rands, and today it's sitting at about 300 rands. Old Mutual is the most recent entry into our business. I'll talk to the Old Mutual slide later on, but it's underperformed. They've got a new CEO, and it's pretty much aligned with our views that the company has underperformed its peers, and he's trying to right the business. CMH, I think despite the tough environment, new vehicle sales continue to do well. I think, double-digit growth that we're seeing on a month-on-month basis. And CMH is well placed there. It's a fourth car dealership business and third in rental. And we think they've got nice exposure from Chinese vehicles, which are taking market share from the incumbent European and American vehicle manufacturers. As a result, we see great opportunities there. On the property side, we've got Fairvest. If you look at the past, call it 15 years, I mean, property has done quite poorly. What attracts us to Fairvest is that they've got some of the best retail assets that you're going to find in the country. These assets are in peri-urban areas, in townships, and rural communities. There's very limited competition in those spaces. Whenever space is available, it's taken up quickly. And we think, as a result, they'll continue to outperform the rest of the sector. Napier Rocastle, it's an Eastern European operator, also high growth region, and Napier also has some of the best retail properties that you can find, and it gives you an 8%, plus 8% yield in euros. Domestic champions, I've got Northern there. We're quite constructive on the BGM space as well. And we've got Momentum. We've been involved with Momentum since 2022. And since we started engaging with the company, we've managed to generate returns in excess of 150%. I think it is the same process that we are looking to follow through in our investment in Old Mutual. Pretty much it's the same thing that has happened there, where the new management team came into place, and they started identifying opportunities where they could drive better efficiencies out of the business. MTN, I spoke earlier on that when I joined Visio, it was to look at the Pan-African market, and we've turned more positive on Nigeria and on the Ghana operations. We think over the next at least year or two, those businesses will continue adding quite considerably to MTN's growth from an earnings point of view. And also, versus where we were, the company couldn't take out cash out of their Nigerian operations. So that situation has changed quite dramatically, and now their balance sheet will be in a much healthier position. I spoke about our engagement with Momentum in 2022. So where we see that there's an opportunity for a company to actually unlock value for shareholders to better run its business, not that we are experts in insurance, but where we'll compare the company to its peers within the industry. And where we see something lacking, we'll engage the management team, we'll engage the board as well on where we believe the opportunities are to actually right the business. So we embarked on that same journey with Momentum, and we've just started with Old Mutual, and we think that over a period of time, it will start yielding results. I think what's quite nice is that Momentum has been engaging in buybacks for the past, call it 3 years, right? Old Mutual has now just entered the party. They've released their results last week, and there they announced that they'll be undertaking a 3 billion rand share buyback, which we expect to last for about a year. So these are cash-rich companies. They generate good returns, and the best deployment of capital when your stock is cheap is to buy back your own shares. So going back to Old Mutual again, I think this is what I was speaking about earlier on. Over the past 10 years, from a sector point of view, you've got Sanlam, which has done just under 115% total return over the past 10 years. But as you can see, most of these companies, the returns have come through over the past 3 years. And you've got Momentum, where we've been invested. It's done 95% over the past 10 years. Discovery followed just under 90%. Old Mutual, on the other hand, a clear laggard here. And it's lagged for a very good reason. It's not been performing at the same level operationally. It's done just under 25%. So we think it's just cheap versus the sector. It is underperformed from a share price point of view. There is low-hanging fruit, and we think it will recover quite nicely. Like I said, we're constructive on PGMs. We've had Sibanye-Stillwater and Anglo Gold Platinum saying production will be down 5% of global supply. That's supportive of PGM prices, and we think we'll continue having a nice rally there. You look at last year, these companies, this time, with the exception of Northam, had negative free cash flows. Now we've got positive free cash flows, and none of them are willing to actually waste that money in new capex, and we think it's quite positive. So I won't go into gold, but just highlighting this chart over here. This shows from a reserves point of view, global central banks are still very low from a reserve point of view versus where they have been historically. Your developed central banks, developed economy central banks are sitting at over 60% gold exposure, whilst developing Russia, China, Brazil, they're all sitting at less than 20%. So there's still scope for big, significant increases in purchases over the next few years. I think this is just a quick summary. We're expecting a recovery in SA. It's delayed, but we think we should gain momentum next year. Globally, things are tough, and SA offers a nice investment opportunity given that valuations remain low. I think this is just a slide that our funds over the past few periods are either first or third or second quartile. And that's it. Thank you very much.
Lilo, thank you very much. Just want to check questions from the audience. Right, no hands. One question from me very quickly. You're also obviously positive on SA equity. You've got your own SA equity fund. But just quickly to test your asset allocation views, you've got the Actino fund, which is a multi-asset high equity. In that fund, what's your positions on SA? Are you overweight SA, and are you then overweighting SA in favor of global, or where are you?
We are overweight SA. I mean, our preference for SA stems from a valuation point of view. I think there's great opportunities in SA versus the rest of the world, as you've seen in the previous slide. And should the environment become tougher, we think there's limited downside. I think one of the key things in our investment process is that we will protect capital at all times, just because of our hedge fund roots.
Thank you very much for that. Anybody else? No, that's it. Lilo, thank you for your time this morning.